In the early hours of Friday morning in Asia, markets woke up to a wave of mixed signals. A stronger-than-expected inflation reading from the United States sent ripples across the Pacific, ripples that quickly became waves on the trading floors of Tokyo, Shanghai, and Hong Kong. The data came from Washington. U.S. wholesale prices in July rose faster than analysts predicted. This measure, known as the Producer Price Index, tracks how much businesses are paying for goods before they reach consumers. When these prices rise, it often signals that consumer inflation may soon follow. Wall Street responded with a cautious retreat. Most U.S. stocks ended lower, a reminder that markets have little patience for surprises when it comes to inflation. Investors fear that persistent price pressures could force the U.S. Federal Reserve to keep interest rates higher for longer, potentially slowing global growth. And yet, the story in Asia was more complex. In Japan, the Nikkei found modest gains. The Shanghai Composite ticked up 0.5%, but in Hong Kong the Hang Seng slid sharply, down more than 1%, as traders digested not only the U.S. numbers, but also troubling news from closer to home. Fresh economic data from Beijing showed retail sales growth slowing to 3.7% year-on-year, down from nearly 5% in June. Investments in factories, infrastructure, and other fixed assets rose just 1.6%, the weakest pace this year, and the property sector, still reeling from years of debt crises, contracted even further. The slowdown is partly the result of rising U.S. tariffs that President Donald Trump extended earlier this year, granting only temporary pauses for 90-day intervals. Uncertainty over trade policy has left Chinese manufacturers wary of new investments, and global supply chains on edge. IIng Economics summed it up simply: Chinese economic activity slowed across the board in July. Cooling momentum suggests the economy may need further policy support. That support could come in the form of interest rate cuts, infrastructure spending, or targeted incentives to boost consumer demand. But Beijing has so far moved cautiously. Currency markets reflected the unease. The US dollar gained slightly against the yen as traders sought safety in dollar-denominated assets. Oil prices slipped, a signal that energy traders anticipate softer global demand in the months ahead. So what does this mean for the average investor? For now, U.S. inflation remains stubborn. The Federal Reserve will be watching closely, weighing whether it can begin to cut rates in 2026 or whether the fight against inflation has further rounds ahead. Asian economies, deeply tied to both U.S. consumer demand and Chinese manufacturing, are left to navigate an unpredictable economic cross-current. The global economy is a delicate machine, one where a single data point in Washington can alter investment flows in Tokyo, Hong Kong, or Shanghai within hours. As inflation challenges persist, one thing is certain: the story of global markets in 2025 will be written not in isolation, but in the constant interplay between nations, policies, and the people they affect.